Imagine you hired a contractor to renovate your kitchen. He shows up, rips out all the existing cabinets, knocks down a wall, and then tells you, with complete confidence, that the result is going to be magnificent. The noise, the dust, the 3 months eating cereal in the living room, all temporary, all worth it, necessary even. Now, imagine checking in 6 months later and the kitchen is not magnificent. The wall is still half down. Your utility bill has doubled. The cabinets that arrived are the wrong size. And the contractor is somewhere else entirely, posting on social media about a different project. That is roughly where the American economy is right now. And today, I want to walk you through exactly how we got here, because 2 things happened this week that, if you look at them together, tell a story that neither the financial press nor the political press has quite managed to assemble cleanly. So, let's assemble it. On Wednesday, the Bureau of Labor Statistics released the CPI report for May 2026. Headline number, 4.2% annual inflation, up from 3.8% in April, up from 2.4% in January. And to put that in context, when President Trump took office in January 2025, inflation was sitting at 3% and it was heading down. It went down further. By the start of 2026, CPI had fallen to 2.4%. That is close to the Federal Reserve's 2% target. That is the picture of an economy that, whatever its other problems, was at least managing to keep prices under control. And then, things happened. By March 2026, CPI was at 3.3%. By May, 4.2%. This is, as the BLS report confirms, the highest reading since April 2023, which places us back in the period when the U.S. economy was still working its way down from the pandemic peak of 9.1%, which was hit in June 2022. Excluding the pandemic entirely, you have to go back to 2008, the middle of the financial crisis, to find CPI this elevated. Now, the administration's response to all of this has been, more or less, that the situation is temporary, that core inflation is behaving, and that the underlying economy remains solid. And on core inflation, which strips out food and energy, they are technically correct. Core CPI came in at 2.9% year-on-year in May, which is not catastrophic. The problem is that food and energy are, it turns out, things that people buy, consistently, in quantities they cannot easily reduce, and energy in May was up 23.5% year-on-year. Gasoline specifically, up 40.5%. That is not a rounding error. That is someone's entire transportation budget. So, where did the energy price surge come from? And here we need to talk about something that has been somewhat euphemistically handled in the financial press. In February 2026, the United States, alongside Israel, launched military strikes against Iran. The operation was called, and I am not inventing this, Operation Epic Fury. The strikes targeted Iranian nuclear infrastructure and killed Iran's supreme leader. Iran retaliated. The Strait of Hormuz, through which roughly 20% of global oil transits, was effectively disrupted. Oil prices spiked toward $120 a barrel, their highest level since 2022. Economists at EY Parthenon, Raymond James, Oxford Economics, and KPMG have all, in their various ways, described this as the kind of energy shock that does not resolve quickly. KPMG's Diane Swank projected that in a scenario where the conflict extends for 3 to 6 months, with significant infrastructure damage, core inflation could hit 4.1% by year-end, a level not seen since May 2023. The base case, she said, still produces a meaningful inflation spike in Q4. Mohammed El-Arian, the Alliance chief economic advisor, and not generally someone given to alarmism, described the situation as a significant inflation shock in the making. The White House called these temporary disruptions, and noted that the March jobs report showed cooling core inflation and declining beef and egg prices, which is true, and also a little like noting that the view from the window is quite nice while the basement is flooding. Higher energy prices raise costs throughout the entire economy. Airlines, logistics, manufacturing, heating, cooling, all of it moves with oil. The Federal Reserve, which was on a rate-cutting path at the start of the year, is now fully expected to raise rates by 25 basis points in December 2026, with markets watching closely to see how incoming Fed Chair Kevin Warsh navigates what Raymond James called probably the worst scenario for monetary policy. The word being used with increasing frequency among economists: stagflation, rising prices, slowing growth, a combination that monetary policy tools are structurally not well designed to handle. Now, here is where it gets considerably more interesting. At almost exactly the same moment that inflation was printing at its highest in 3 years, the semiconductor sector experienced one of its worst weeks in recent memory. Broadcom fell 12%. Micron was down between 13 and 16%. Nvidia dropped roughly 6%. AMD and Intel both shed around 11%. The VanEck Semiconductor, ETF, a broad basket of chip stocks, fell sharply. In aggregate, over $1.3 trillion in market capitalization was erased from semiconductor and AI-related stocks in a matter of days. The immediate trigger was Broadcom's earnings. The company projected third-quarter AI chip sales of $16 billion, strong by any ordinary measure, up over 200% year-on-year, but below Wall Street's whisper number of $17.2 billion. Management did not raise its full-year AI semiconductor forecast. That gap between what was expected and what was delivered was enough to send the entire sector into retreat. Now, this is where two things are happening simultaneously that are worth separating. The first is the short-term valuation story. Semiconductor stocks and AI-linked stocks broadly have been priced for a future that assumes continuous exponential growth in AI infrastructure spending. When any piece of guidance suggests that growth might plateau, even temporarily, the repricing is violent. Because a great deal of the value in these companies is not based on what they are earning now, but on what investors believe they will earn in 5 years. Interrupt that narrative for even 1 quarter, and you lose $1 trillion in a Thursday. The second thing happening is more structural and more directly connected to policy. Since January 2026, the Trump administration has imposed a 25% tariff on certain advanced computing chips, including the NVIDIA H200 and AMD MI325X, under a Section 232 national security designation. And there has been explicit discussion of extending that to 100% tariffs on all imported semiconductors from companies not manufacturing in the United States. The stated logic is force chip production back to American soil. The ITIF, the Information Technology and Innovation Foundation, published an analysis in May 2025 making the case that this logic fails in practice. The argument: semiconductor fabs are planned years in advance, take up to 5 years to construct, cost billions to build, and are determined by up to 500 variables, not just tariff rates. A 25% tariff does not move a fab. It just raises prices for the Americans who buy the products that depend on chips. And those products are cars, which now carry an average semiconductor content of over $1,000 per vehicle. Laptops, smartphones, medical devices, Wi-Fi routers, household appliances, LED light bulbs. The list, as one analysis put it, is essentially a list of modern life. A 25% tariff on imported chips means an extra $188 in chip costs per car before any other tariff impacts. That gets passed to consumers, which is how chip policy becomes inflation. There is a version of the Trump economic argument that goes like this. Yes, there is disruption. Yes, there are temporary price pressures. But the United States is at the center of the greatest technological revolution in human history. AI investment is flooding into American infrastructure, and the long-term payoff is enormous. And there is something to that argument. AI capital expenditure has been extraordinary. The build-out is real. The technology is advancing rapidly. But there is a question that Senator Rick Scott, a Republican who has actually been studying the AI sector and bringing tech executives in to brief his colleagues, essentially answered out loud when asked about it this week. When pressed on whether Trump's AI acceleration was putting the market into a bubble, Scott said, and I am quoting, "There's no logic to the explosion in AI stocks." And when pressed further on whether this was sustainable, he declined to endorse the market's current valuation of AI companies at all, noting he wouldn't be buying stocks trading at 50 times earnings, which is a useful data point. Because the person saying this is not a critic of the administration. He is a Republican senator who has been given the briefings, who has talked to the companies, and whose conclusion is that the stock prices don't reflect rational valuation. He wore a pin that said "jobs" to a press briefing about artificial intelligence. The irony of that was apparently not intended. Meanwhile, the AI build-out is having a concrete inflationary effect that is separate from the energy and tariff stories. The chip demand generated by AI data centers is enormous. And because chip manufacturers like Micron have been redirecting their output toward higher-margin data center customers, there is now a shortage of memory chips for consumer electronics, smartphones, laptops, the devices ordinary people buy. IDC has projected that the global smartphone market faces its largest year-on-year demand decline on record in 2026. Volumes down 13% to their lowest level in a decade. The memory crisis is partly what hit Micron so hard in the sell-off. The AI build-out is also, as the CPI report itself indirectly noted, pushing up utility costs. Data centers require extraordinary amounts of electricity. That electricity demand drives up prices for residential consumers. The technology that was supposed to reduce the cost of everything is, for now, adding to the cost of energy for ordinary households. The one deflationary benefit that consumers have reliably enjoyed for decades, the steady decline in the price of electronics, is now reversing. Chip costs embedded in televisions, appliances, and devices are going up. The thing that was supposed to be the silver lining is starting to look like part of the problem. So, what actually comes next? Energy prices will likely moderate at some point, assuming the Iran situation doesn't escalate further, which is, of course, not a given. Core inflation may well stay relatively contained. The Fed's rate hike path will be cautious because Kevin Warsh has inherited a situation where the wrong move in either direction has significant consequences. The semiconductor sector will almost certainly stabilize. The AI investment thesis is not going away. But the repricing that happened this week reflects something real. A market that had priced in a growth trajectory that was always going to face, at some point, the friction of actual reality. That friction arrived. What is considerably less likely to reverse quickly is the broader structural situation. Chip tariffs that raise prices for manufacturers and consumers. An energy shock that, according to multiple economic forecasts, will keep prices above pre-war levels throughout 2026. A Federal Reserve that is now more constrained, not less. And an AI build-out that is consuming resources in ways that are measurable in household utility bills right now, today, before any of the promised productivity gains have materialized. The American consumer, as the New York Times report cited by Breaking Points this week noted, is the main thing keeping prices from being even worse than they are. Not because conditions are good, but because consumers are running out of money and cannot sustain demand at higher prices. That is what economists call demand destruction. It is, in the bluntest possible terms, the poverty version of price stability. The Trump administration came to office with a specific theory of the economy: tariffs as leverage, deregulation as stimulus, energy dominance as a competitive advantage, AI as the technological moonshot that would carry the whole thing forward. What the data from this week suggests is that the tariffs raised prices. The energy dominant strategy ran into a war that made energy the problem, and the AI moonshot produced, so far, a semiconductor sell-off, rising utility bills, and a Republican senator quietly telling reporters that the stock prices don't make sense. That's not an argument that the theory was entirely wrong. Economic policy operates over long time frames, and the full picture is not yet written. It is, however, an argument that the kitchen is not yet magnificent. I'm Marcus Fenn. This is Borderlines, analysis from the edge. Subscribe now and be here while this story is still unfolding. The most important chapters, as it turns out, tend to start in the data that nobody is reading carefully enough.